The long-term yields are breaking out, with the 10-year, 20-year, and 30-year Treasuries all moving sharply higher. But this isn't just about inflation or the Fed. We at Blueon believe it's about a new fiscal reality in the United States, one defined by a growing US deficit, sticky inflation, and a recent credit warning. The real story is in the 30-year yield. Since Liberation Day, it has climbed nearly 100 basis points, pushing above 5%. That's a level we hadn't seen since October 2023, and before that, not since the lead-up to the 2008 financial crisis. This kind of move isn't just noise. It's signalling deeper structural risks, from persistent deficits and stubborn inflation to waning demand for long-duration US debt. To understand why the long bond is reacting this way, we have to look at what's happening beneath the surface, starting with the debt. Since 2008, US debt has only gone in one direction: up. After the financial crisis, marketable debt surged by nearly $7 trillion, rising 36 percentage points of GDP by 2013. Then came COVID, and marketable debt exploded again, jumping another 22 points to hit 99% of GDP by 2021. Today, the US sits at around 97% marketable debt to GDP. And the new House budget bill Trump is pushing for approval? It could push that number to 125% by 2034. Even without extending the Trump tax cuts, the path still leads to 117%. But it's not just the size of the debt that matters. It's the inflation risk that comes with it, and markets are starting to price that in. While headline inflation has cooled, long-term expectations are heating back up. According to the University of Michigan, 5 to 10-year inflation expectations just hit their highest level since 1991. This isn't a blip. We believe markets are adjusting to a world shaped by persistent fiscal spending, supply-side friction, and a Federal Reserve that may be constrained by politics and rising interest costs. This backdrop of persistent inflationary pressure makes the credit landscape even more fragile. First it was Standard & Poor's in 2011, then Fitch followed in 2023, and now in May 2025, Moody's has issued a negative outlook on US debt. That was the last major agency still holding America at AAA and now at AA1. Their message is clear: rising deficits, political dysfunction, and no credible plan to stabilize debt. It's not a downgrade yet, but it's a sign that even US Treasuries are no longer seen as bulletproof. And for bond investors, that means higher risk premiums, especially at the long end. Now here's the strange part. Long-term yields are spiking, but the US dollar is falling. Normally higher yields pull in capital and support the dollar. This time the opposite is happening. Why? We think because foreign demand for treasuries is drying up. Big holders like China, Japan, and oil exporters are stepping back. Add high hedging costs, and US bonds lose their appeal. Combine that with rising debt and credit concerns, and the dollar starts to look less like a safe haven. So how do you position in a world of rising long-end yields, sticky inflation, and fiscal risk? First, stay cautious on duration. If yields continue to rise, long bonds still carry downside. Second, inflation-linked bonds like TIPS are back in focus. Real yields are positive, and inflation isn't out of the picture. Third, keep an eye on gold. In an environment where confidence in the dollar is slipping, hard assets tend to shine. And finally, consider steepening trades. If the Fed holds steady while long-term yields climb, the curve could steepen, and that opens up macro opportunity. Long-term yields are sending a message. They're pointing to deeper issues, from ballooning deficits to eroding credit trust, sticky inflation, and weakening demand for US debt.